Check out this headline from Yahoo Finance. The Federal Reserve will cut interest rates 6 times in 2024 as the economy shows clear signs of cooling down. ING says, let's unpack this puppy. All right, guys, real quick, if you're trying to take advantage of the 20% discount on my real estate mentorship before the end of the year, you need to go to the link below, book your call, and use the code 2023. Also, if you haven't joined my free Burr real estate investing group, you need to do that. Go down to the show notes, click the link, join us completely free. You meet a lot of people and hopefully learn a lot of information. Let's rewind back to 2019. The economy's on fire, everybody's feeling good, and then a pandemic happens. And so then we hit these choppy waters for a while where we're not really sure what's going to happen. Is the market going to tank? Obviously saw a big drawback in the stock market that scared everybody. But about 3 to 4 months after that, we had a large boom again once everybody realized that this virus could be handled. It wasn't going to necessarily wipe out all of humanity. And so it was just this weird up and down ride where we were kind of drew back, and then all of a sudden we just went on a slingshot ride and propelled forward rapidly. So you look at 2021, 2022, the markets absolutely took off. You can look at the stock market, you can look at real estate, and we were really crushing the economy. Interest rates were low. People were able to acquire houses with very cheap debt. They were able to buy a bigger house, more affordable house, supplies super low. It's just going absolutely crazy. So what started happening? Well, inflation started happening, because when you look back, we were printing tons of money in 2020 all the way through really 2022. Debt was still very cheap, and so this inflationary period really started taking off. And so the Federal Reserve said, hold up, wait a minute, put a little high interest rates in it. Okay, I don't know if that should have been said. But anyways, they had to put in high interest rates to curb inflation and slow this crazy boom, quote unquote, that we were seeing down. And so if you were to purchase a home in 2021, you were paying somewhere between a 2.7% interest rate to maybe a 3.5% or 4% interest rate, where today you're paying around 7.5% to maybe upwards of 9.5%. And guess what? These high rates have done their job. The feds wanted to raise these rates so that we could slow the growth of the market down, slow inflation down, to bring everything back to normal. And if you look at what's going on in the economy, that is what's starting to happen. And that's what this article in Yahoo Finance is talking about. We have a cooling jobs market. There's a deteriorating outlook for consumer spending. And when we look at housing, homes are starting to sit a lot longer. I think back in 2021, the average day on market for a house was about 32 days. I'm going off of memory here. And I think today in 2023, we're looking at 50 plus days that houses are sitting on the market. And if you ask me, I think the 30 days back in 2021 is actually a low number. I just remember if somebody put a decent house on the market in 2021, it was gone within like 3 to 5 days. So I don't know where they came up with that 30-day median, but that's the number. But just know that the length of time that homes are sitting on the market is creeping upwards of doubling from just 2 years ago. So we had this real big booming housing market, but what happens when homes start to sit longer like they are today? Prices drop. So the cooling job market, people spending less money, houses sitting on the market for longer and dropping in value. This is what the feds wanted to see when they started raising interest rates. So because the feds are getting the outcome that they set out to achieve, now they want to start stimulating the market again, but they don't want it to all happen at once. They want it to happen over time. So ING's chief international economist, James Knightley, expects that the feds will start cutting interest rates in the second quarter of next year, which is 2024, delivering as many as 6 25 basis point rate cuts totaling 150 basis points. He also says he expects interest rate cuts to extend into 2025 with at least 4 25 basis point cuts then. So right now, the interest rates for the feds are sitting at around 5.33%. Based on what Knightley's saying, at the end of 2024, we're looking to be at around 3.83%. And then by the end of 2025, we're looking at 2.83% rates from the feds. If you've been struggling finding good real estate deals, I've got a solution for you. It's REI Call Center. REI Call Center has professionally trained and managed cold callers to help you scale your real estate business. I think they give you somewhere around like 1,500 cold calls per day. Their clients have closed around $10 million from the leads they brought in. They got close to 200 clients going right now, and they're really more than just cold callers. Yes, they have their team of professionals who are making their calls, but they have weekly trainings and Q&A calls for yourself. They have training videos. They've got Slack channels with dedicated people to make sure you're successful. They've got checklists, cheat sheets, you name it. They've got you covered to make sure you are successful in your real estate journey. Well, how does it all work? Well, step one, you're going to pull a targeted list working with them from PropStream so that you can target the certain locations that you want to start buying properties in. Second, they're going to use their Zen call platform to start calling 1,500 calls a day per cold caller. They're going to then upload all the leads into Asana. You have a view of them and you can go attack and start buying the properties that you see that pique your interest without having to do any other work. Look, I have worked a W-2 job while building my real estate portfolio. I've been raising a family the entire time, so I haven't had time to go and cold call myself. And that's where a company like REI Call Center comes into effect to be able to take that load off your plate so that you can generate leads, close more deals, and build that portfolio. You can reach out to them at reicallcenter.com, or if you go to the show notes of this episode, you will see a link that will take you directly to them. What they're trying to do here is what's called a soft landing. They don't want to just drop these rates really quickly down to zero because that's going to create issues and most likely lead to a recession. So if they can gradually lower these rates a few times per year, they know this effect isn't going to take place right off the bat. It's really going to be a 12 to 18 month period before the effects are really felt. But I think the feds know that the economy's skating on thin ice right now. If they don't do something, we have the opportunity to enter a recession, which then makes it harder to bounce back and get the economy where it needs to be. And so whether this article is spot on as to when rates are going to come down, or maybe they missed it by a few months or half a year, we can bet that at some point rates are most likely going to come down from where they are today. But before I dive into that, I want us to look at what are rates today compared to where they've been in the past, because there's this misconception that rates are extremely high right now, while in fact they're not. Check this out. In the 70s, the average mortgage rate was somewhere around 9%. In the 80s, it was somewhere around 10.5%. 90s, call it 8.5%, 9%. In the 2000s, we started at about 8.15% and finally got down to 5.14% just before 2010. And then since 2010, onwards to where we are today, we have started to see those declines in rates. But when we look back at history, just over the last 50 years, it has not been normal to have 2, 3, 4% interest rates. In fact, it will be interesting to see if we ever see that again in our lifetime. Was it fantastic for those of us who buy real estate and want cheap debt? Absolutely. The house that I sleep in every night, I have a rate under 3% on it, and it's amazing. But we have to understand that that's not the norm. And so if we're looking at this from an investor lens, a real estate investor lens, do we stop investing and buying real estate just because rates are higher today than what we have been used to seeing? Unfortunately, I think many folks have, but if you do that, then you put yourself in a position to miss out on opportunities. And then you have to look at your opportunity cost versus what that interest rate is. And just a quick refresher on opportunity cost, it is the potential benefits that an individual investor or business misses out on when choosing one alternative over the other. So play this scenario out with me. You don't buy right now because interest rates are high. And so you think just because this one metric isn't perfect, that you should not go and continue adding properties to your portfolio. Why is that a bad idea right now? Well, because there's not a lot of competition out there, because most people are thinking like you are. Where the rest of us who go out and say, you know what, yeah, interest rates aren't the most ideal they've been in the last 5 years, but there are still tons of deals out there that I can add to my portfolio. But even further than that, for those of us who are buying right now and you don't buy, what happens when ING and other economists who are saying that the feds are going to start lowering rates here in the next 1, 2, 3 years? And when they start lowering rates, people start purchasing more property again because debt's less expensive. So now there's more competition in the market. And because we have such a supply shortage, in addition to rates potentially being dropped, now you have this perfect concoction for prices to continue soaring like we saw them doing just a few years ago. It's an old saying for investors, whether you invest in the stock market or you invest in real estate or whatever type of asset, it goes like this: stop trying to time the market and spend more time worrying about time in the market. Never going to be able to time it perfectly. Hardly ever do the stars align. And when they do align and people hit those grand slam deals, those grand slam investments, it's because they've been doing what we call in the stock investing world dollar cost averaging, which just means they've been buying consistently over and over and over, month after month, year after year. And so because they're always in the market, they're continuing to buy houses, continuing to add rentals to their property. They don't let the news and fear mongers get to them. They say, nope, I know what constitutes a good deal, whether interest rates are 9% or whether interest rates are 4%. And I'm going to stick to my strategy and I'm going to execute it over and over and over and over again. And there's going to be some times where the market aligns perfectly and I look like a genius. And then there's going to be other times where I continue to buy great deals while others are on the sidelines. And at the time they're calling me a fool. Then just a few years later, they're looking back and said, man, I wish I would have done what you done. You got lucky. You bought at the right time. You bought in 2024 when rates were high and prices were starting to come down. You just got lucky. That's what people be saying about me and everybody else who invest in 2030. So you can choose to either join the group who gets lucky every year because they decide to take action, or you can continue sitting on the sidelines. You know where I stand and where I always stand. And for those of you who aren't standing on the same side of the line as me yet, I hope to see you soon. Hey, take a quick second and subscribe to my channel so you'll be notified when new videos come out, and then like this video. It helps share it to other people. I really appreciate you guys taking time out of your day to listen, and I'll see you next time.